Ladies and gentlemen, and the one cat from Connecticut, this presentation is not very good and will only get worse. The Gassman presenter is a real dummy. Stephen Evers is way better than being on this program. But if you're on the program and you can't escape, like maybe you're a kid in timeout and your parents said you have to watch this program because you've been so bad, well then let's make the most of it. Here comes Gassman. Don't tell him what I said. Thank you. Okay, welcome to the new pension IRA contribution and other rules under the Secure Act. I'm here with a friend who has made me look good many, many times. All I have to do for my clients is say, do you have a defined benefit plan or a cash balance plan? And the client goes, what's that? And I say, it's a certain type of pension plan that could be mixed with your 401k, and you might get a lot more benefits out of the plan. And then the client says, gee, that was never discussed with me. I don't think it would work. I have a lot of rank and file employees. And then I say, well, let my friend Steve run some numbers and see how that might come out. And sure enough, quite often, the numbers come out well. So I'm really glad to have Steve here. He is a very well qualified pension technician and designer. And we're going to talk about the changes that have come about under the Secure Act and Secure Act 2.0 in the pension world. Before we get started, I want to mention that if you came in through the CPA Academy, you'll have to answer the 4 polling questions, no matter how dumb they are, but any answer will be a significant, good enough answer. Secondly, if you came in through our website, you have my condolences if you have nothing better to do today than to watch this presentation. But if you are a Florida lawyer, you can get continuing education credit through the Florida Bar. Just let us know that you attended. If you have a question, you can either email me at agassman@gassmanpa.com and we'll answer it later. You have Stephen's email address, stephen.evers@voya.com, or go to the Upside Down Pyramid, sing the Pyramid song by Steve Martin about King Tut, and while you're doing it, type in your question, and then if we know the answer, we'll answer it. If we don't know the answer, we will pretend not to see it. You can get a free copy of our Thursday report, both now and for the rest of your natural life, by emailing info@gassmanpa.com. I won't get into too much detail here. I want to mention that at the end of this presentation, at about noon, it may seem later, we're going to do another yet other free demonstration of the Estate View software that I'm working on. And if you want to be a beta tester for the software, you can send us an email and we will gladly accommodate beta testers. So a lot of upcoming programs that I won't spend any time talking about. You've got the slides which show you what they are and when you are. I am excited if you are a music fan, and especially a brass music fan, or specifically a Canadian brass music fan, make sure you join Chuck Dallenbach and I Saturday, June 17th at noon. It's going to be from noon until noon. So I guess it's going to be either 24 hours or there's a typo there. Chuck is the most prolific tuba player in the history of mankind. He has recorded more albums than any other tuba player, and he has made more performance appearances than any other tuba player. And I am confident that he is also the funniest tuba player in the entire universe. So I'm really looking forward to that presentation. We're going to talk about how the Canadian Brass have been the most successful touring group in world history outside of rock and roll. They are a brass band and really wonderful people. So Stephen, I've given you a little bit of an introduction here. Is there anything else that you want to say about your background or that you might warn us about before we begin your part of the presentation?
The only thing I have to add is that I apologize. I'm not nearly as funny as Alan is. And despite the content, I will try to not be dry.
Okay. I have a squirt gun, so if it starts getting dry, we'll water it up. All right. So Stephen, this starts your slides, and I'll let you take control, and I'm going to sit back and really enjoy this. I will interrupt you 3 or 4 times for polling questions, but that'll give you a
Okay.
chance to take a quick break. Go ahead.
All right. Thank you, everyone. I appreciate you being on this webinar today. As Alan mentioned, my name is Stephen Evers, and I'm the Regional Vice President for Voya Financial, covering Northern Florida, parts of Georgia, Alabama. But no matter where you're located, feel free to reach out to us. And, if I can't directly help you, I can get you connected with someone that can. So we're going to be talking about the Secure 2.0 changes and some of the retirement plan legislation that was modified towards the end of, it's past the end of 2022. There are different effective dates of when some of the legislation actually does become effective. Some of it's for 2023, some of it's for 2024, some of it's for 2025, and some of it actually goes even further into that. And that kind of brings us into this first slide. So some of the big things that people think about with retirement plans, the things that everyone knows about are required minimum distributions and the types of sourcing of what we can put into the plan. So required minimum distributions with the Secure Act 1.0, which was passed at the end of 2020, that did increase the retirement minimum distribution age initially from 70 and a half, which was for the longest time when you were required to start taking distributions out of retirement accounts, and it bumped it up to 72. Well, with Secure 2.0, that's going to increase to age 73 for 2023, but that's only, it is going to depend on when your date of birth is. So depending on when you were born, it increases to 75 in 2033 for if you were born after, if you were turned 74 after 12/31/2022. So if you're 73 or you attain age 72 after 12/31/2022, then your RMD age will be 72. If you turn 73 after 12/31/22, sorry about that, it goes to 73, and then it turns to 75 once you get into 2033. So like I said, the provisions are scaling of when they actually take effect. The requirement, the distribution age does change right now, but it will change again in 10 years, according to that schedule. The other thing is the contributions for catch-ups. They are going to be required to be Roth moving forward. So right now for 2023, the deferral limit for a 401k plan is $22,500 plus a $7,500 catch-up contribution. So if you're over age 50, you can defer $30,000 of your pay for the 2022 or 2023 plan year. Starting in 2024, depending on your compensation, any catch-up contributions will require to be Roth contributions. Now, the limit is $145,000 right now. It is going to be indexed for inflation, so it will continue to go up, but it's not directly tied to the highly compensation employee limit, which is a typical, for this year, it's $165,000. And typically when we're inside of retirement plans, when we're making limitations like that, it's tied to the HCE limit. So this is one of those things that's not going to be tied directly to the HCE limit. It's going to be indexed a little bit lower. But for 2023 or 2024, if you made over $145,000 in 2023, you're going to be required to make your catch-up contributions as Roth contributions. And if you're part of a retirement plan that doesn't allow for Roth contributions, in order to accommodate that catch-up piece, they are going to have to modify the document in order to allow for Roth contributions. Otherwise, employees that are over that $145,000, again, indexed for inflation limit, would not be able to make catch-up contributions. Let me go back here, because one thing that's not on this slide that I did want to mention, and we're going the wrong way.
Steve, let me mention that about 20% of our viewers are not CPAs or tax lawyers. So RMD stands for required minimum distribution. That's the age when you have to start taking those distributions out of your IRAs. And then tell us, Steve, quickly, what is a Roth 401k, or what were you referring to on the right-hand side of that screen?
Sure, it's talking about how the contributions are going to be taxed. So typically when you're putting money into a retirement plan, you put it in on a pre-tax basis. So you're taking a deduction for the contribution now, and then it's going to grow tax deferred. And then when you're ready to start taking the money out, whether it's through your own volition or through the required minimum distribution, you'll be taxed on that money when you actually take it out as ordinary income. With the Roth contributions, you are paying taxes on the money now. It will grow tax-free. And then when you go to take the money out, assuming you meet other qualifications, it's going to come out tax-free. So it's just the timing of when you want to pay the taxes. Are you going to pay it now, or are you going to pay it down the road? And there's some other things that we'll talk about with Roth contributions that are changing that make a lot of sense of what they're trying to do. But the Roth versus pre-tax is really just how and when the contribution is going to be taxed for you.
And what is a catch-up contribution? I'm sure it has nothing to do with mustard.
So once you turn age 50, you're allowed to put additional money into the retirement plan. It's also indexed for inflation. Like I said, this year for 2023, that number is $7,500. So if you're over age 50, you can defer out of your own pay an additional $7,500 to get you up to $30,000 total for this year. Starting next year, that's going to change to where if you're over that index compensation limit, you can still deduct on a pre-tax basis that $22,500. But if you want to do that full $30,000, that extra $7,500 of catch-up would have to be Roth or after tax. So you'll have a split bucket. You're going to take the deduction for the chunk of the money now, but down the road, you're going to have a little bit of a tax-free bucket growing as well because of that required Roth.
Thank you very much. Very good.
And one more thing with the required minimum distribution, really it's so that they can make sure that you're not just hoarding all your money in a tax-free bucket until you ultimately pass. So that's what the required minimum distributions are for, is forcing you to take money out of the plan. And like I said, they've changed the ages from 70 and a half to 72 to 73, going up to 75 in 2033. But it wasn't a slight penalty if you didn't take that money. So before this year, it would be a 50% penalty if you didn't take your required minimum distribution. So if you had a sizable RMD, let's say you had a $50,000 RMD, if you didn't take it, typically by April of the following year when it's required, or the end of the year once you've been in it for a few years, you'd be subject to a 50% excise tax. So, hey, here's my 50 grand, but I have to give 25,000 of it directly back to the IRS as a penalty for not taking it on time. They've also modified some of those penalties. So instead of being 50%, it's going to be 25%. And if you take it within a timely manner after the deadline, which it doesn't quite stipulate what a timely manner is yet, I'm guessing it's going to be, a couple of quarters following, then that penalty will actually reduce down to 10%. So a couple of changes with the RMDs on the age and then the penalties if you don't take them on time. One of the really big changes for retirement plans is the credits to start up a retirement plan. So a big push of this of the Secure 2.0 in general, was to get more employees into the plans so that people can start saving, because you're much more likely to save in a qualified retirement plan through your employer than you are outside of it, but also to give proper incentives to the businesses to actually implement the plans to begin with. Because you can try to incentivize employees as much as you want, but if your employer doesn't offer it, you're limited really to just an IRA or a much smaller level of contributions. So what they did before this year, there were credits in place. The credit was $250 for each non-highly compensated employee, which is an employee that makes under $130,000 a year. Like I said, that's indexed as well. So next year that goes up to $165 actually, with the levels of inflation that we've seen. So if you were a non-highly compensated employee and you're in the company would get a $250 credit for each one of you that they had in the plan. So if you had 10 employees that were non-highly compensated employees or lower paid employees, the company would qualify for $2,500 of credits. $250 times 10 employees. That capped at $5,000, and it was also capped at 50% of your actual fees. So if you had $5,000 of fees, you could get the full $2,500 credit. But if you only had $2,000 of fees, you were only going to get $1,000 of credit. So the first thing they did was they bumped the actual number up from 50% to 100% of qualified plan costs up to $5,000. So if you have $5,000 of costs or expenses for your retirement plan for the first 3 years, you get a credit back for that entire amount. And that's not a deduction, that's an actual credit. So you're effectively, if your fees are $5,000 or less, you're able to operate that plan for the first 3 years at no cost to you because you're getting credits back from the government for the entire fee. The other thing is a contribution credit, and this is really a game changer for a lot of retirement plans. Alan mentioned we do a lot of cash balance plans. I was working on a plan at the end of the year last year that she was going to qualify for $2,500 of tax credits. She had it was right about that 10 number of eligible employees plus herself, and then she had a son that was in the plan as well. So 12 total employees, 2 of them considered highly compensated. She was going to get $2,500 of credits to implement a new plan. I called her back at the beginning of the year because she was kind of hemming and hawing around whether or not she wanted to do it. And I told her about these new credits. And starting in 2023, she now qualifies for $17,000 of credits. And for her, it went from, I'm not really sure I should do this, to this is a no-brainer. I have no out-of-pocket costs for my staff, whether it's from the actual expenses for operating and maintaining the plan, or the required contributions that have to go in, because you do have, with cash balance and defined benefit in particular, you're going to have some level of obligation to, and I just clicked forward again. You're going to have some level of obligation to your employees for that. That contribution credit is $1,000 per eligible employee that makes under $100,000 of wages. So again, before Secure 2.0, most of these limitations were assigned highly compensated employee status or non-highly compensated employee status. And it was easy to differentiate whether or not you qualified for some of this stuff. I mentioned, the credits are now capped at $100,000 of wages. When we're looking back here, we had the catch-up contributions that were indexed at $145,000. So now we have different levels of compensation that we need to pay attention to depending on what we're doing. And it's not as simple as saying, well, do we have highly compensated employees versus non-highly compensated employees? So right now, if you have employees that make under $100,000, though, you can qualify for $1,000 of credits for each one of them. So if you're doing just even profit sharing or profit sharing in cash balance, and you've got, let's say your obligation is $1,500 to one of your employees, typically it's going to be 5 to 7% of what you're going to have to give them. So let's say your obligation is $1,500, your actual outlay is really only $500 because you're getting, again, a $1,000 credit back from the government to offset those contributions.
So it's not only the cost of setting up the plan, but it's the money you put in for the employee?
Exactly. And the next slide has a table that will kind of break down how that works, because that does scale down as you go into the plan. But it's really sizable dollars. Like I said, we went from $2,500 of credits to $17,000 of credits for this one employer. And it's really, like I said, it's taking businesses from, I'm not really sure I want to do this, to, yeah, this makes perfect sense for me to do, and I'd be silly not to do it, or I'd be a dummy not to do it.
Now, is your software programmed to tell you what the credit is when you design the plan now?
We have some calculators that we can use. So once we figure out what, we'll run the illustrations, figure out what the obligation is to the employees, and then there's a calculator where you can plug that in, and it'll tell you exactly what you're able to get.
That's fantastic. I mean, that's great for helping Americans save. Great idea.
Absolutely. And then in addition to those 2 credits, you can also get an additional credit for opting for automatic enrollment, which is $500 for the first 3 years of the plan. The contribution credit does scale off. So it applies if you have 50 employees or less, you get 100% of the credit. And then over 51, it does start to scale down. And then once you get over 100, it goes away. So it's really incentivizing smaller businesses to implement these plans. If you have over 100 employees, they figure you probably already have a plan in place or something along the lines of that anyways, and the incentives don't quite go as good for you. Another thing is that, we're starting to see a real uptick in multiple employer plans and pooled employer plans. And before Secure 2.0, any of these credits that you were able to get were based off the effective date of the multiple employer plan or pooled employer plan that you were going to join. not when you actually join it. So one of the changes as well is the credits will apply when you actually join that multiple employer plan rather than when it was started. So if you've had a multiple employer plan that's been in place for, a decade and you're just joining now, you can qualify for this full level of credit to offset your cost for joining that plan.
Great.
This is the table that I was talking about that kind of breaks down when the credits will expire for you. So this is the table that tells you the contribution credits. Like I said, the first 2 years, you get 100% credit. Year 3, it goes to 75. Year 4, it goes to 50. In year 5, it goes down to 25. The fee credit is $5,000 for that first 3 years. And the automatic enrollment credit is also $500 for the first 3 years. So you can see here, we're talking about a hypothetical employer of 20 employees and that's all employees that have under $100,000. So we have 20 eligible employees that we're talking about here that have $1,000 in annual profit sharing contributions. And the plan also has automatic enrollment, which is how we're getting this credit. So 20 employees times $1,000, that's a $20,000 credit that we're getting on the contribution side. Add in that $5,000 fee credit for the first 2 years, this employer would qualify for a full $25,000 tax credit. So again, you're looking back to last year, 2022, if they were going to start this same plan, they would get $5,000 of tax credits, which would be $250 for each one of the employees. So 250 times 20. And that's it. They're getting $5,000 for the first 3 years.
Okay,
now they're getting 20.
Okay, sorry. What is auto enrollment? Is that where you enroll your automobile, or how does that work?
So automatic enrollment, when it was originally put in place, it was called negative election, and they realized that had a negative connotation for the employees. And they're like, well, why am I negatively electing into this plan? But essentially, once the employee becomes eligible, you are automatically put into the plan. Typically, those plans are between 3 and 6%. So once you become an eligible employee, we're going to automatically start taking 3% of your pay and put it into the plan for you. You can opt out of it, obviously. But most plans before the end of 2022 were, regular enrollment. So you become an employee, they give you an eligibility form, they say, hey, fill this out if you want to participate. Now, moving forward, it's going to be, here's the form. If you don't want to participate, fill this out. Otherwise, we're automatically going to put you in at X percent. Like I said, that typically starts somewhere between 3 and 6%.
Okay, so I'm going to do the first polling question now. Are we okay, Josh? So the first polling question is, do you know a law student who has pro bono obligations, they have to work for charitable purposes, that may want to write for the National Institute for Charitable Education in any way? And either A, yes, in which case we may ask you who they are, B, yes, but I don't like this particular law student, so I don't want them to know about the opportunity, or C, no. Okay, so answer A, B, C, and time's up. Let's go back to whatever page we were on here. What were we on, about 22? Nope. Sorry about that. All right, Steve, where do you want to go back to?
Right there. Oh, one more. There we go. So like I said, this employer would be capped at $5,000 of credits under the prior legislation. Now they get $25,000 for the first 2 years, and then it starts to scale down, mostly because of the contribution credit. For that third year, it scales down to 75%, so they still get $15,000 of credit. And then in the fourth year, the startup credit and the automatic enrollment credit scale off entirely, and we're just left with the 50% and 25% of the contribution obligations. And a lot of profit sharing plans are going to be a discretionary contribution. So in the plan year, you do have to make this contribution in order to qualify for the credit, obviously. But sizable credits for small employers to put these plans in place and to fund contributions to the employees. A lot of times, when we're doing profit sharing, cash balance, defined benefit plans, like I said, you're going to have some level of obligation to your employees if you're going to do a plan like this. Now, if you're a solo business owner, you don't qualify for any of these credits, but you're getting the entire benefit for yourself. So this is for group employers once you have at least one eligible employee, starts to tail off after you get to 50. So this is really targeted for that 2 to 50 space to incentivize them to put a plan in place and do contributions for their employees.
Steve, how about relatives who are on the payroll? If you're related to a highly compensated employee, do you still qualify? Does the employer still get the credit?
So it depends on the level of family attribution. So immediate relatives are considered highly compensated employees, regardless of whether or not they meet that compensation limit. So if your spouse works for you, if your child works for you, or if a parent works for you, they're automatically considered highly compensated, and they would not count towards this calculation for you. If it's a sister or a brother-in-law or a stepchild or something along those lines, then we don't have to attribute the ownership to them, and they would still qualify for this.
Okay,
so really, it would just come down to.
Yeah, so divorce could be a good strategy here.
Well, that's one of the things that it's not in the slide deck, but we used to have, if you had minor children, you still had to attribute ownership, and it could affect exactly what you said. So if you divorce somebody, but you have a minor child, you were still all considered to own the exact same property.
Okay,
Part of Secure 2.0.
Yeah, so let me ask you one more thing. It used to be that you would have to start your pension plan by the end of the plan year. So for a December 31st S corporation or partnership, you would have to have the plan in writing by December 31st. Now, what is the deadline for a 2022 calendar year pension plan and contribution?
Sure, and that actually changed with Secure 1.0 when that went into effect in 2020. So as long as you're doing employer contributions only, you can adopt a retirement plan up to effectively your extended tax filing deadline. Now, you really can't wait until the absolute deadline because there's other work that has to be done, like doing the plan documents, opening investment accounts, filing 5500s. So because there's work that has to be done before the end of the filing year, we had set an internal deadline of June 30th. There were exceptions that came in after that. But if we're going by the letter of the law, if you're an S Corp or an entity that files by September 15th, you could go up to September 15th to put a plan in place and get deductible contributions for that the prior calendar year. With Secure 2.0, it also allows, if you're a sole proprietor, you can adopt a 401k plan as well up to your tax filing deadline. So you can actually backdate employee contributions as well. And that's why, other than for sole proprietors, it's employer contributions only, because we can't go back into the prior year and tell our employees, hey, we have a 401k plan, would you like to contribute? So that's why if you're a group employer, you can only do employer contributions after the end of the year. If you are a sole proprietor filing under a Schedule C, they just made it so that with Secure 2.0, you can do employee and employer contributions.
Okay, so Steve, I'm going to get off the subject here on something that's important. We've got a few hundred CPAs and enrolled agents on this webinar. Is there a rule of thumb as to when a cross-tested defined benefit plan or cash balance plan may work? Is there any sort of rule of thumb? Because you have a couple of physicians who are in their 50s and 9, 10 staff, and the numbers come out quite well. But what could an attendee read or look at, or besides sending you a census and having you tell them, when would we know that cross-testing would be worth looking at?
So whenever you're doing cross-testing, or it's also called new comparability, and really it's just a type of age-weighted contribution. So that's another way of me saying that we need to have a proper age breakdown for the staff compared to the ownership group. Typically, you want at least a few employees. And when I say a few, I'm talking, 30, 40% of your eligible employees, you're going to want to be younger than whoever we're targeting a benefit towards. So if we have, in your situation, we have 3 doctors, and the 3 doctors are age 45, 50, and 55. If we want to get sizable contributions to each one of those doctors, we would need to have several staff members be really 5 to 10 years younger than that youngest targeted employee. So we'd want to have, like I said, probably about 30% of the eligible employees, the non-target employees, that are going to be 35 or younger. That's not to say that it won't work if it's all 40-year-olds, but if you're targeting a 45, a 50, and a 55-year-old, and all of your staff is in their 60s, it's not going to work for you. It's going to cost way more money than you're going to be willing to outlay, and it's just not going to be worth it for you from a contribution outlay standpoint.
Okay. All right. I want to do another polling question. Hopefully I can get us right there, but no, I've got to scroll. Okay. Polling question number 2. For those of you, wake up, there's a polling question. Meow, meow. Okay, would you be interested in sponsoring minority students to participate in an estate planning council? In your estate planning council? A, yes. B, please send information. Or C, what was the question? Please answer A, B, C, or even D. And 1, 2, 3, do, re, mi. Back to the. Sorry about all the scrolling here. What do we cover next?
Is that where we're? Okay. So some of these provisions, like I said, they go into effect at different times of the calendar years. Some of the provisions that are going in for 2024. So before this year, if you had Roth dollars, again, so money that you've already paid taxes on and it's just growing tax-free for you, and when you take it out, it's not going to be taxed. You still had to take a required minimum distribution if that money was inside of a 401k plan. If it was in an IRA, you could just keep it in the IRA and let it keep growing, and you never had to take money out of it. But inside a 401k, the required minimum distribution rules still apply to you. With Secure 2.0, that's no longer the case. So if you have Roth money inside of a 401k, it is no longer taken into account starting in 2024 for your RMDs. Now, if you have half of your money in pre-tax and half of it in Roth, we'll still have to take an RMD based off of that pre-tax money that's in the plan, but the Roth portion is no longer considered. And if you convert it or have all Roth money inside of the plan, then there's no RMDs required at all.
Okay.
Another thing that goes into effect in 2024 is the force out limit. So if you have employees with smaller balances inside of your plan and they're terminated, as of right now, that limit is $1,000 for a cash out, or if under $5,000, you can force them into an IRA. That is increasing to be $7,000 starting in 2024. And that's not indexed. So we'd have to wait for more legislation to pass down the road to increase that at all. I'm kind of surprised that they didn't index it, because the 5,000 number had sat around for a long time, and it took a while to change that. And they only bumped it up by a couple of $1,000. But it's not going to be indexed. So for the time being, like I said, until they pass additional legislation, $7,000 is going to be that number to be able to force employees out. Some other changes that are coming in 2025. So again, with Secure 1.0, there were some changes to the legislation that said, so typically with a 401k plan or any qualified retirement plan, we have eligibility provisions inside of the plan. Most plans, I'd say 90%, are age 21, 1 year of service, semi-annual entry. And that 1 year of service is quantified by a certain number of hours worked during that 12-month period, typically 1,000 hours. So if you had an employee that worked less than 1,000 hours, even if they were a long-term employee for you, they were never going to be eligible for the plan to begin with. Secure 1.0 changed that to where if you had a certain number of hours over a 3-year time frame, you'd have to offer them at least the 401k component. You don't have to give them matching contributions or profit sharing contributions. You have to at least open the 401k piece to them. The Secure 2.0 changed that even further, and now the minimum requirements go down to 2 years. So employees would be eligible as of the earlier of 1 year of service, or if they work for 24 months and had at least 500 hours during that time frame, then they would still be eligible for the 401k piece. So you can no longer keep people out of your plan completely if they work between that 500 and 1,000 hours. Like I said, you're going to have to give them a 401k benefit, but it's not going to count towards some of your testing. So it's not going to affect the rest of your plan, but you are going to have to accurately track those employees and make sure that you're figuring out when they're going to be able to come into the plan. And honestly, even when the 1.0 passed, we saw a lot more employers go towards more lenient eligibility requirements so that they didn't have to separately track two pieces of eligibility. There's also higher catch-up limits. So I mentioned that it's $7,500 right now if you're over age 50. Those are going to increase starting in 2025. So once you get to age 60, it's going to increase your contribution to $10,000, which is going to be indexed for inflation, or 150% of whatever the regular catch-up number is. So, right now, age 50 is your only catch-up increase. You're going to have a catch-up at age 50, and then once you get to 60, you'll be able to make additional contributions. They're adding a retirement lost and found, essentially. So once an employee terminates, they'll go into a bucket to where you can help find some of those lost employees. That's been a big issue of especially some of those small balances. If we're trying to force them into a cash distribution or into an IRA distribution, it can be hard if you can't find those employees, get an actual address for them, and the money just gets lost and left in the middle of nowhere. So this does create a registry for those employees. So you'll be able to log on to a website, type in your name and your information, and see whether or not you have any retirement savings sitting out there for you. And that last one doesn't really apply too much. So a couple of new design features are going to be emergency savings withdrawals and in-plan dedicated savings accounts. So these are just additional accounts inside of the retirement plan that are going to be added for the employees. And it's really just a way, there's been a lot of studies about this. There was one that came out last year that I think surprised a lot of people, that 60% of Americans didn't have enough savings to cover a $400 emergency. So these were put in place to help employees get funds from their retirement accounts to pay for some of those unforeseen emergencies that come up. Like I said at the beginning of the presentation, and the credits of why they're doing everything is to try to get more employees into these plans and more employers offering these plans. The downside is, some may see it as a downside, is that the money is pretty much locked into the retirement plan until you're 59 and a half, or you take a penalty, or you qualify for a specific type of hardship withdrawal. These are put in place to not necessarily be a hardship withdrawal, but actual emergency needs. So if your AC breaks or your car breaks down, those are not right now allowable reasons to take money out of a retirement plan, but under these new provisions, they would be. And these also go into effect in 2024. The first option is going to be just an emergency savings withdrawal. It's capped at $1,000 per year. You can only take one per year. There's no 10% penalty. It is self-certified, so the employer doesn't have to worry about getting any documentation on it. And you do have to replenish that $1,000 before you actually take another distribution. So in addition to being $1,000 per year, if you take it in 2024, you'd have to put that $1,000 back into the plan before you could take out another emergency distribution in 2025. In addition to the emergency savings withdrawals, they're adding a dedicated emergency savings account. A lot of the providers are still figuring out how this is going to be implemented, but we do still have some time since it doesn't go into effect for next year. But that can be up to a $2,500 emergency account inside of the existing defined contribution plan, which would be a 401k, profit sharing, et cetera. All these contributions are raw, so it's going to be that after-tax contribution. So it'll grow tax-free for you, and you can take it out without tax penalties. But highly compensated employees cannot participate in this. So it really is just an additional benefit for the rank and file employees. And both of these are put in place so that they're not scared about participating. We can have loan provisions and hardship provisions, which have been allowed for quite a while. but those were never really enough to get some of the lower paid employees to put more money into the plan. With these two options, if you have something that comes up, you're able to get your money out without penalty, to pay for some of those unforeseen circumstances. Student loans have been all the rage, the last 5 years or so. And some plans had started to kind of self-implement some matching contributions on student loan payments. But with Secure 2.0, you're allowed to do that without any special provisions needed. And the matching contributions can go towards those student loan payments. So if you have, a $500 a month student loan payment, and that's prohibiting you from contributing to the 401k plan, the company can now offer you a matching contribution based on you putting $500 towards student loans, even if you're not participating in the 401k piece. That's going to be allowable in 401k, 403b, 457 plans, and simple IRA plans, which is also a big change because a lot of these types of changes are usually excluded from those. But regardless of the type of defined contribution plan you have, you can match the student loan payments for them. The other thing with this, it is self-certified as well. So the employer's not going to have to worry about tracking, what the actual amounts are. Some may want to, but if your employee says, hey, I'm paying $500 a month in student loan payments, the employer can take that and run with it and match contributions based on them having $500 of contributions. And it's treated just from a testing standpoint, from a contribution standpoint, just like that $500 is a 401k contribution, but it's actually going to be the student loan contribution. Another option that's going to start taking effect next year is having employer contributions be dedicated to Roth contributions. So right now, the only way to get Roth money into a plan is through your own money, the money that you're taking out of your paycheck and putting into the plan. That you can do on a pre-tax or an after-tax contribution. With the Secure 2.0, your employer, when they put match money into the plan, when they put profit sharing money into the plan, they can now designate that as a Roth contribution for you. Now, there are some requirements with that, most notably that the contribution must be 100% vested immediately because the employee is going to be taxed on that money during that year. So you don't want to have a vesting schedule, which is typically, an ownership level of that contribution. You don't want them to be taxed on a $1,000 contribution, only be 25% vested on it, and end up having to reconcile the taxes at the end of the year. So the IRS just said, let's just make it 100% vested automatically. That way that we don't have to go back and try to recuperate any of those contributions or amend tax filings. If you want to do the Roth for the employer side, that's fine, but they have to be 100% vested in those sources. We talked a little bit about automatic enrollment not too long ago. Having the employee, instead of opting into the plan, they have to opt out of the plan. Before this year, it was an optional provision to add to your plan. And you saw you can get a $500 tax credit for doing that. And the tax credit's not going away. You still get that. But for any plan that's in effect for starting in 2025, you have to put, from the start of the plan, it has to be put in place with an automatic enrollment provision. And one thing that's not on here is this provision actually takes effect December 31st, 2022. So if you start a new 401k plan January 1st, 2023, you technically can have the plan in place 2023 and 2024 without automatic enrollment. But starting in 2025, you would have to amend your plan to add the automatic enrollment provision. So at this point, most plans are just adding it right now off the get-go. So you're not going to have to worry about amending the plan 2 years down the road. If your plan was in effect before 1/1/2023, so 12/31/2022 or prior, then you're not subject to this. You don't ever have to add automatic enrollment if you don't want to. But if you're adding a 401k component as of 1/1/23 or after, eventually you will have to have automatic enrollment in your retirement plan. As you can see, you are exempt if you have 10 or fewer employees or if you've been in business for less than 3 years. But that the change would still apply if you ever got over 10 employees or once you're in business for 3 years. So you would, again, have to amend your plan down the road to add automatic enrollment if you don't do it from the get-go.
Steve, I'm going to take us to slide 55 for the next polling question. Okay, which of these books would you like to receive for free? A, 8 Steps to a Successful Florida Estate Plan. B, The Florida Physician's Guide to Creditor Protection. C, Grow Your Medical Practice. Or D, What Estate Planners and Others Need to Know About Bankruptcy. So the answer is A, B, C, or D. Josh, let me know when we have enough people answered. We're good? All right. Fast crowd. Back to page 35. We're almost getting good at this. Go ahead, Steve.
So there's also an additional saver credit for low-income employees. Again, just to further incentivize people to put money into these plans. It must be contributed back into your plan. So when you get the credit, you have to put the money into your retirement plan or into your IRA. The maximum credit is 50% of your contribution, up to $1,000, with various phase outs at different income levels. But effectively, this takes, if you're going to put money into the plan, you know, you're in a 401k plan, and I'm going to put $1,000 of my money into the plan, you're getting that money back at the end of the year. So it's just further incentivizing employees to put money into the plan, you know, through credits, through, different pieces. If you're married, you can get some of the credit up to $68,000. That's what I was talking about, the phase out. So it is truly for, lower income families, and that goes into effect in 2027. Some other just provisions they put in to just try to simplify things. It eliminates the first day of the month rule for 457 plans. So what that means is right now, if you're in a 457 governmental plan, you had to make an election for contributions at the beginning of the month. That no longer exists. So you can set one election for the entire time frame. It simplifies notices for employees who are eligible but haven't actually enrolled in the plan. So right now you have to give out specific notices for fee changes, changes to the plan, annual reports. Even if the employee is not in the plan, you still have to give them all of those. The simplified notices say that as long as they have the summary plan description and they know that they're in the plan, you don't have to keep on providing the rest. Self-certification of hardships, that's a really touchy subject for a lot of employers. In the past, there's a lot of documentation that you would have to get to approve a hardship distribution for an employee. So those hardships are, if you're buying a house, if you're trying to prevent eviction or foreclosure from a house, medical expenses, education expenses, funeral expenses, you had to submit all your receipts and paperwork showing I had X amount of obligation for these, and then you could gross it up for taxes as well. Starting in 2023, the employer can just say, how much do you need? The employee can self-certify on that. We'll see, how that affects the actual number so far. I can tell you so far we haven't seen a huge uptick of hardship requests, but it may just be that employees don't know that they don't have to self-certify anymore, or that they can self-certify now. So they haven't started to take, too much advantage of it. Also, we can allow for.
But it is a federal crime to falsify a hardship distribution request. Because I know there was jail time spent by somebody a couple of years ago because she falsified a hardship request.
It definitely can, and that's why some in the industry are skeptical of the self-certification of the hardship piece. The emergency distributions and things like that, especially since you have to repay it anyways, self-certify, it's only $1,000, you have to repay it anyways. For some hardship requests, they can get sizable dollar amounts, and because it is penalized and you don't have to pay it back, we'll see how it goes. But for the time being, you are able to self-certify starting in 2023. Again, just trying to get people to get into these plans. You can allow for small financial rewards, typically under $100, such as a gift card or, donuts are going to be far less than $100, obviously, to incentivize people to contribute into the plan. So you say, hey, we're going to automatically enroll you. As long as you stay in, we'll give you a $50 Publix card. If you opt out, you don't get the Publix gift card. So just further trying to incentivize people to contribute and stay in these plans.
So is $99 safe? Is $100 in the statute, or what's safe? What's the most I could give, and can I write it off?
There's no actual guideline yet for what small financial reward means. It's generally accepted that it's going to be under $100. It is, any other business expense, so you can deduct it if you want to. But right now it just says a small financial reward. There's no actual dollar amount in place.
Okay.
Again, simplifying the actual provisions. If you have an operational error with your plan and you fix it on a timely time frame, you can self-correct that instead of having to go through the voluntary correction program, filing applications with the Department of Labor and the IRS to fix it. You can just do that yourself. And then, I mentioned the consolidation of notices with employees that are not enrolled, just trying to make it easy on the employers of communicating with these employees. So this is more of a detailed analysis, really highlighting some of the things that we talked about. This is a slide of what's going into effect for 2023, the mandatory options, or the mandatory provisions and the optional provisions. Most of this we did talk about, RMDs going up to age 73. I mentioned the excise tax reduction. It wasn't on the slide, but I did highlight that as well, that it's going from 50% to 25%, and then 10% if you do it timely. The 457 elimination. If you're a firefighter, you can take distributions once you're age 50 and avoid the 10% penalty. Early withdrawal provisions. These are really about the emergency distributions. These are all optional provisions that you can put into the plan. One of the big ones is 403B plans, being able to be in a pooled employer plan or a multiple employer plan. That's not something that's been allowed in the past. And we're starting to see a lot more uptick of private, so 401k plans going into these types of arrangements. It'll be interesting to see how 403Bs are affected with that. The employer contributions going into Roth, that is an optional provision. And I think until we understand how some of that's going to work, most providers are going to hold off on implementing it. But I would think in the next couple of years, that's going to be more of a required provision. Self-certification of hardships, elimination of the certain notices. So again, just a highlight of some of the stuff we talked about, but this is specifically to what's effective for the 2023 plan year.
Okay. Can I mention, if we go, first of all, let's do the last polling question so some people might disappear. Here's the last polling question. Are you interested in a free study group on the $50,000 IRA transfer to charitable remainder trust? So Steve showed you one of the slides, the minimum distribution rules from IRAs and the ability to transfer up to $100,000 from your IRA to charity if you're over 70 and a half were changed by this rule. And what this rule says is that each taxpayer over 70 and a half has the chance to shift up to $50,000 in a calendar year from the IRA, not directly to charity, but instead to a charitable remainder trust. And then the charitable remainder trust can make annual distributions to the taxpayer, with the remainder going to charity. So what this does, although it's only $50,000, what this does is it allows you to stretch that minimum distribution payment beyond your 71st birthday several years, over a period of years, as long as it is a bona fide charitable remainder trust. Now, a lot of people say, well, it's not going to be worth the time and trouble. There are charities who do the charitable remainder trust for free and even help you manage them for free, and they will be glad to break bread with you with hopes of getting future donations. And if you're a married couple, then you could do identical charitable remainder trusts. The other thing that the legislation allows is a charitable annuity. So, for example, if you were to send me $50,000 that I would deposit into the Sarah Gassman Foundation, which would then pay for piano lessons for needy children at $23 a lesson, I can agree to pay you I can agree to give $40,000 or $45,000 to Vanguard in exchange for a life annuity on you. And then I can receive those annuity payments, pay them to you, keep the $10,000 spread, and spend that on piano lessons. So these things are worth looking at. And here's the polling question. Are you interested in a free study group on the $50,000 IRA transfer to charitable remainder trusts? A, yes. B, no. C, please call again at our convenience. Gave you a little rest there, Steve.
Thank you, sir.
Okay, where were we? 39? I was 39 once.
I am 39.
Perfect.
This is a summary of the provisions that are going in for 2024. So, you know, again, we talked about a lot of this, safe harbor corrections for certain failures, or, you know, self-correcting operational failures, catch-up contributions required to be Roth, elimination of the Roth 401k RMD requirements. That's a really big one. And these are all the mandatory provisions. And then we have the optional provisions that are going in place for the 2024 plan year as well. We got just a few minutes here, so let me scan through these. For 2025 and later, here's some of those provisions that are going to affect. Really the biggest one is the catch-up contributions that are going to start increasing once you turn age 60 and being indexed so that you can put a lot more money into the plans once you're age 60. I mentioned also the part-time eligibility for your part-time employees, having to track that and bring employees in that might not otherwise be eligible for you. Automatic enrollment and auto escalate for new plans in starting 1/1/25. Like I said, if you put the plan in place in 2023, by 2025 you are going to have to make that change, even if you didn't start the plan in 2025. The federal database for the lost participants, some amendment pieces that's more, you know, on the operational side of things, and then the savers credit as well for some of that stuff.
Okay, so Steve, we have time for a couple of questions here, and there's only about 96 of them. Okay.
Perfect.
Lawrence says, I'm reading that the maximum combined 401k employee and employer contribution total in 2024 will be $73.5, including over 50 catch-up. Since employee contributions are capped at 30, does that mean a company can contribute 43.5, i.e. 145% matching?
So yes and no. Yes, that is the projected limit. No on the actual matching contribution. So, really, it would depend on the compensation amount of the employees, because you're limited to 25% deductibility for these plans. So, you know, you may be able to put in that amount of money for the employee, but you're only going to be able to deduct 25% of that. And, you know, let's be honest, most of the time you're only going to want to put money into the plan as a business if you can deduct that expense. So, you know, theoretically, yes, you could put more into the plan for an employee, but you're only going to be able to deduct 25% of your eligible payroll.
Okay. This is from Brooks. If I own 100% of my S corporation and I make a 401k Roth contribution that goes into my Roth 401k account, does the company get a deduction? Do I have income? Seems too good to be true. How does that work?
So as an S Corp, you are required to, in order to have eligible compensation for the business owner in an S Corp, you have to take a W-2. So that Roth contribution would be reported on your W-2 as an after-tax contribution. So you as the employee, the S Corp gets the deduction for the payroll piece of it. So we're saying, hey, I'm paying you $100,000 in salary. That's the deduction for the S Corp. You as the employee would not get a deduction for that. You put the money into the plan, and then it would grow tax-free for you.
Okay, well, another question is, how are the simplified employee pension rules implicated or changed by all of this for SEPs?
So there wasn't a lot with the SEPs that changed. The simple provisions, like I said, we can have Roth now. We can allow for loans now. So some of the provisions that were only available to true 401k plans are now available to the simple plans. But for the most part, and the credits as well for implementing the plan and putting everything in place. So most of the changes do now apply to simple plans, whereas before a lot of it only applied to 401k plans, and you didn't get the full benefit of a retirement plan by offering the simple.
Good. Here's the last question. If the plan is, if a company already has a 401k plan in place in 2021 and 2022, is there any way that that employer can do anything that would qualify for the credit? By adding employees, adding another plan, standing on their head, anything?
So you would qualify for whatever the schedule is of where you're at. So if you're in the third year of your plan, you could apply for that third year credit. The one thing you can do, no matter where you're at with the effective date of your plan, is the automatic enrollment piece. So if you've had a plan for the last 20 years and you're going to add automatic enrollment now, you would get that $500 credit for implementing automatic enrollment.
Okay, great. Well, Steve, this has really been fantastic. The feedback has been wonderful. Would you be willing to come back and just do an hour of questions and answers about pension and qualified plans, et cetera? Just the Steve Evers show?
Yeah,
One full
sounds
hour?
good.
That'd be great. Okay, well, we will definitely have you come back. Appreciate it very much. Congratulations on the new job and on being 39. I hope your 40th birthday party is open bar and you invite me and everyone who's on this call.
I just turned 39, so I have one more year to enjoy being under 40.
Okay, very good. All right, well, Steve, you're welcome to stick around or to go do your thing. Thank you again very much. You do a great job for clients who don't have plans or who do have plans. If I can send you their census, you always make me look like a hero, and I really appreciate that.
Thank you, I appreciate that.
Okay, so now we're done with the hour of continuing education. I want to show you where I am with the Estate View estate tax planning software. A lot of you have seen it. I'm very interested in having beta testers. You would have a couple of months free use of this software with no obligation to ever buy it. And let me show you first what it is, what it does, and then I'm going to go through it pretty slowly, talk about estate tax planning techniques that it uses, and I will use this as an instructional video for our beta users as long as I do a decent job of it. So there are 3 modules in the Estate View estate tax planning software program. This is not an income tax helping program. It's for estate tax illustrations and planning. The first module shows you a married couple. If they both die today, I'm sorry, a married couple. Let me go to a married couple. Married couple, they both die today, and you see their estate tax situation. Or you have growth during their lifetimes and you see a more dire estate tax situation. Or they do a little planning and fund a credit shelter trust on the first death, a bit less dire. Or they actually do some annual gifting into a trust for their children and grandchildren, a little bit less dire. Or they gift discounted LLC or partnership interests, a little more savings. Or they use life insurance trusts and life insurance planning, more savings. Or they use an installment sale, more savings. So on the right-hand side, we have the different planning modes. On the left-hand side, we have the inputs. And in the middle, we have the readout. So that is the first module. I'm going to come back to it and spend the vast majority of my time on that module. The second module is an installment sale calculator. This enables you to see the inputs a little bit more clearly and to see a spreadsheet of the results of an installment sale to a grantor trust and to export the spreadsheet to an Excel spreadsheet where you can do further work on it with the client. So that is the second module. And I'll bring back out of that. Sorry, let me go back. By the way, it is web-based, and there it is. Okay. I can restart it very easily by going to estateview.link, opening 1.1 once it knows my password, and I'm back there. And I've shown you this module, I've shown you the installment sale calculator, and now we have a qualified personal residence trust calculator. This is brand new, not seen before. Click there, and here on the left are my inputs. Here's a 70-year-old with a 10-year term and a $3 million house. The gift to the 10-year Cupert, which I'll explain later, is a 41% of value gift. So the amount that of the exclusion that you use is $1,251,347. And then it runs a spreadsheet to show you what the outcome is based upon when you tell the computer that the term will end, including rent income, which occurs after the Cupert term. And then if you want to do 2 Cuperts, one for each married couple, I could put half of a home in 1 Cupert, take perhaps a 25% discount or a 22.5% discount on value, and get that gift even lower. And then if I want to do a second Cupert, I can hit duplicate, and then it's going to show me a second Cupert right there. So it's going to run those Cupert numbers quite effectively. Okay, so going back to the module, and I apologize, let me close that. For some reason, it's not letting me go back. Stateview.link. Point 1, all right. So here's the initial module that I showed you. It's where you're going to spend most of your time, and I'm going to show you the inputs now. So here I can put my law firm name, Gassman and Dummies, and here I can put my name, and then the client's first name, second name, either age or date of birth, and you can simply scroll up and down like that if you like, or you can type it in, male or female, and it will then tell me their actuarial life expectancy, which is expected to live to 2035. If I click male, it goes to 2033. If I go to female, it shows me 2035. If the person is a smoker, it's 2035. If they're not a smoker, it's 2039. And then I can put what year the computer will tell me they die, 2039. And then what are they saving from their earnings until any particular age? So I can say this person is going to work until age 74, and he's going to save $300,000 a year from his earnings. And then when he hits age 74, the rest of his life, he's going to spend $200,000 a year from his investments. Now, here is the spouse, can be male or female. This spouse is 10 years younger, age 64, and will live to life expectancy 2042. Let's face it, if they're wealthy and not smoking, they'll probably go longer. They have better medical care than the general population. And this spouse, on her own, brings in $75,000 more than she spends and expects at age 70 to go to negative 100. We'll be spending 125 more. Now, let me point out this income here, 300,000. Let me go to 500. And let's just pretend that 200 of that is coming from an S corporation income. I'll be telling you later why that's important. Okay, will they be using the portability allowance if one dies and the other doesn't use their portability allowance? We'll assume they will. And then will the exemption drop by 50% in 2026? Let's be optimistic and say it won't. They have a 1,750,000 home growing at 3.53%. They have a business and investment assets worth $30 million, growing at 8.23%, costing 0.5% a year in investment costs, and let's say 2% a year in income taxes as a percentage of value. And the maximum amount that we can put in a credit shelter trust on the first death, the computer will tell us, is going up, up, and up here, a fairly high number. And we could set that number to whatever we want it to be. Then they have 2 children now. In 11 years, they'll expect to have a couple of more grandchildren. So that would be 4 people that can accept $17,000 a year gifts. And that 17 a year will go up with inflation automatically in the calculations. And they expect that they may use their annual exclusion not by making cash gifts, but maybe 20% in cash and 80% under a using LLC interests. So I'll move this down to 80%. And when they transfer LLC interest, they're going to take a 30% discount. Now, on the life insurance front, the first spouse is spending $5,000 a year on an existing life insurance policy for the next 10 years. And then after that, we'll have to pay $20,000 a year for life. Oh, I'm sorry, for another 10 years. And of course, this is all adjustable. Change that to 8. And the death benefit is $1 million for the first 11 years, then $1.3 million after that. And afterwards, it will be the same thing, but we'll have a life insurance trust. So I'm clicking to add a life insurance trust. Same thing with spouse 2, general assumptions, and then a life insurance trust. And I'll move this down to a more realistic level of 600,000. And here I can move that to 600,000. And then they could have a second to die policy if we want to give them a second to die policy and a second to die life insurance trust. And then an installment sale that I'll come back to. I'm setting the consumer price index growth rate at 3.21%, which is pretty common. And I'm setting the estate tax rate at 40%. Now, if they live in a state that has a 5% state estate tax, we're not going to be able to track that exactly, but we could just put in 45%, and that'll be close, and to some extent, depending upon the state you're in. And then if I want to put a special note in the letter to them, I can just say, thanks so much and for looking at this. Okay, so with the numbers that I've just input, you're now fairly familiar with the numbers, and you see it takes about 4 minutes to put these numbers in. What can I tell this client? Well, first of all, if they don't do no estate planning and they die at the end of this year, they're going to have 30 million plus 1,750,000 and 1.5 million in life insurance. And on the death, they're going to have an estate tax of 3.3 million. So it's not a dire situation for them. But if they do no planning and they simply use portability allowance and the exemption doesn't go down, then I click here, no planning, and the estate tax is now going to be $26 million. And the total going to their beneficiaries is going to be $87 million. And then they say, well, what if we die sooner or later? Well, I could click up and down on the ages, or I can go to timeline. I click here on timeline, and it shows me what the estate tax would be on the second death in any of these years. And it shows me that I have a little life insurance trust there, a little life insurance, and then just a lot of business and investments, little personal residence there at the bottom. And what comes out is in red. That is the estate tax. So, and by the way, the details behind this, I can click there. It gives me some numbers just to give an idea of how the numbers look. So then what if we just fund a credit shelter trust on the first death? The first dying spouse dies. $21 million goes into the credit shelter trust. It's never subject to estate tax on the second death. The estate tax is now $22 million. Now, at this point, the client says, wait a minute, I forgot to tell you, we have a vacation home, and I'm sorry I forgot to tell you about it. Well, what's it worth? Well, it's worth $500,000. Okay, I'll just move this to $2,250,000, and all the numbers just adjusted, and you see them adjust. So then the client says, well, I think my investments aren't really worth 30 million. Let's go 27,750. Okay, well, the numbers automatically adjust. The next mode I show the client is the annual gifting mode. I explain that if I set up an irrevocable trust with their 2 children, so that's 4 power times 17,000 for 16 years, growing at 8.23% after the fees, not reduced by the income taxes because the client pays those income taxes because the trust is disregarded for income tax purposes. By the second death, that trust has $5.7 million that passes estate tax free. But if I do the discounted gifting, discount by gifting LLC interests, I click there, and now that trust has $7.6 million. The estate tax is down to $16 million. And at this point, the client may say, enough, too complicated. I don't want to do anything else. And then I might say, okay, but just keep in mind that if the exemption goes down, like it's scheduled to do in 2026, then your estate tax is 27 million, not 18 million, because you can put so much less in the credit shelter trust. So, that's not good. So let's do the life insurance planning. Click on life insurance, and now we see a lower tax. Before the life insurance, the estate tax is 18 million. With the life insurance, it's now 17 million. Now, the life insurance agent may say, let's put some more life insurance in there. Well, that's good because the life insurance death benefit passes estate tax free, but you typically are going to use part of your gifting allowance to allow the life insurance to happen. So does it work? How much do you save if you add another life insurance policy in an ILET? And this will tell you how that works by looking at the timeline. If I go to life insurance planning and I go to the timeline, it will tell me what year I need to die in order for this to help. And by the way, I can move the second death left and right here without having to scroll here. Isn't that neat? Okay, so that's the life insurance. Now I go to my favorite planning arrangement, and that is the installment sale. And when I click, well, I'll go back to Trust Logistics, and let me show you the situation for an installment sale. So the client, let's say, will put $10 million into an LLC. So here I can just type in $10 million. Now, what did you just see happen? I think this is really neat. Assuming that there will be a 25% discount for non-marketability and lack of control, because I'm going to give a 99% non-voting member interest. I put $10 million in an LLC, and then I will sell that interest for $7,500,000, But first I need to make a seed capital gift to the trust. The rule of thumb is at least 10% of the sale amount. So I'll put $750,000 of investments in the trust. Now, if the client says, you know, that saves a lot of money, I'm willing to go 12 million. Okay, just click it up to 12 million. It automatically tells you what your sale amount is, and it tells you what your seed capital gift needs to be. And then the client says, well, you know, my friends are using 33% discounts with their valuation firm. Okay, I'll put in 33. Now it tells me that to make a $9 million gift, I can put 13,432,000 in the LLC. Okay, what's the interest rate? I'm going to use the long-term applicable federal rate. I can look it up by clicking here. Takes me to the government tables there, and that will tell me my my interest rate. Let me go back to estate view. Okay, so I'm going to put in 4%, or let's say right now it's 3.88%. I'm going to use a conventional note. It's not going to cancel on death. It's going to be a 20-year note, and the grantor is going to pay all the income tax on this trust because it's disregarded for federal income tax purposes. Now, remember I said he has an S corporation that makes $200,000 a year. So beyond the fact that this 13 million includes the ownership of the S corporation or S corporation non-voting member interests or non-voting stock, this trust is going to receive $200,000 a year. And by the way, this is indexed with inflation. That's going to reduce the income that they receive during their lifetime by $200,000 a year, which can make a significant discount. And then I'm going to say the S Corp's going to go well for 10 years. After that, it may only make $50,000 a year because the client may not be participating as much. So then I'm going to say, is there a guarantee fee on the note? If, for example, the client only wants to make a $250,000 seed capital gift, then in lieu of a larger seed capital gift, they could pay the gifting trust or some other entity a guarantee fee. So I'm going to have a guarantee fee of, let's say, 1.25% of the amount owed each year for 15 years, and it's going to go to the gift trust. So now what do? I click on installment sale, and that's where I was. And that installment sale brings the estate tax down. Before installment sale, that estate tax is at 17 million. Now with the and it looks like that, pretty steep estate tax. The installment sale brings it way down, and that is the installment sale trust right there in blue. And you also have the second to die life insurance trust there in light blue. But logistically, I'm click full fit. Logistically, I still got some estate tax to pay. So what I can do now, if I want to zero out that estate tax, I can go ahead and determine how much needs to be put in the installment sale. I can't put more than I have, but I can max the installment sale. And if I can do an installment sale of 20 million with a $14 million note, then I'm in good shape. And does that keep me from paying estate tax no matter when the date of death is? Go to the timeline, and yes, it does. So that would be a possible estate plan. Now, one other thing I want to mention, one more button that I think is interesting. You know, the client may say, all right, I'll do the gifting, nothing more. I don't want to do the installment sale. My kids are still getting 89 million. Well, that assumes no inflation. If you assume a 3.21% inflation rate, then your children are not getting 89 million. They're getting 43 million in today's dollars, and that's a low inflation rate. So in fact, if you want to say a 5% inflation rate, then they're only getting 30 million. But if we can do the installment sale, now they're getting 33 million. At least that's a lot more. All right. So now what do? I want to show this to the client. I want to explain it to them. So I click generate client letter. Now the computer is going to draft a Word document, and it can show any one or more of these scenarios. And I'm just going to click all of them. I can select all scenarios. And then it can show me just that logistical chart that we stayed most of the time on, or it could also show me the timeline chart. It could also show me the details. So I'll show off here. I'll click those boxes and I will hit generate client letter. Now the computer is drafting the letter. It shows you here how far it is. It's like little squirrels typing this letter. By the way, the software is web-based. You don't have to use the client's real name. You can use an assumed name, although the way we're preparing this, your client's information will be confidential. The program will work on any computer or an iPad or a Google Pad or even on your phone. The program does not take into account IRAs. It doesn't take into account a lot of different things, but it does everything that I just showed you. So at least you can guesstimate what you should be doing. One of the next things we're going to do is integrate the QPERT into this particular module. So here comes my letter. There it is. And the letter at the bottom says, thanks so much for looking at this. So my customized print went in there. Now the letter explains the estate tax system. It shows you all the inputs, so you remember what they were. By the way, this can also be saved to your computer. And then the letter shows all of these diagrams and charts in color, each step of the way, and tells you what your savings is. For example, the credit shelter trust saving 666,000, etc. So then I can save the letter, print it, send it to the client, and then do another letter with other assumptions. I don't have comparisons of the letters yet. I hope that that will happen eventually. Another thing I can click File, and I can save this. I can also just save a single screenshot, like this picture here. I hit that, and now the screenshot is saved on my computer. There is a help item, which we're still working on. I'm going to have 5 law students over the summer writing all the help items. And then I have an account item where you'll be able to handle paying for this so that I can repay myself for the programming expenses, which are pretty significant, but they don't cost as much as a boat. All right, so that's the first module. Now I want to go to the second module, the installment sale calculator. It's pretty much the same inputs as you saw. Oh, I'm sorry, I forgot something. I'm going to go back here. Let me see. Well, I'm going to have to talk to Kevin about why I have to keep going back there. But anyway, stateview.link. It's saved for me. I can also go to single. So spouse 2 here, same situation for spouse 1, but spouse 2 died. We're sorry. And now it's going to do these things for a single person, which is very nice. And you can say, well, did spouse 2 have a portability allowance? If yes, how much was it? And did spouse 2 leave a credit shelter trust? And if so, how much is in it? So that's nice. And then I can generate a single person item. So I guess while I'm here, before I forget, both in here and in the installment sale calculator module, I can make a higher interest rate and make the note self-canceling. Now, right now, the software does not tell you what the interest rate would need to be for a self-canceling note, but that will be coming in hopefully weeks, not months. All right, so back to the installment sale calculator. This shows you year by year what the result is of the installment sale and allows you to export the results to a spreadsheet. See what happened to it. There it was. The spreadsheet is around here somewhere because I'm on multiple screens. But in any event, where is it? There it is. See, I printed 3 of them. You can see I'm not very good with this. But anyway, take my word for it. There it is. Open spreadsheet, and it should be here somewhere. All right. If you can't dazzle them with brilliance, baffle them. All right. So now going to the next module. Coming back, go to the calculator. Here is the Cupert. So the 75/20 rate, the computer automatically knows. Transfer date is today unless I change it. The grantor is 70 years old, expected to die at age 85. The term of the Cupert is 10 years. The home is worth $3 million. It's going to grow at 3.4%. We're going to give 100% of this property. So, and after the Cupert term of 10 years, the grantor is going to start paying rent. So that's going to cause his estate to be less and the trust to be worth more. And the number of years rent will be until he dies in year 15. Gift tax rate is 40%. We're using the best possible mortality table. Inflation rate 3.71. So we know here that the gift is $1,251,000, and there's a 68% chance that this grantor will live the 10 years. Now the grantor may say, hey, I'm a smoker and I don't want to take chances. I don't want to die during the term because then there's no estate tax savings. Okay, well, we can go down to 8 years. I like to go at about 80% rate of, so 7 years. So now the gift is $1,695,000. We'll use that much credit, but the whole house will be out of the estate. And assuming a 15-year life expectancy, that will have a $7,100,000 out of the estate. How does that look from a spreadsheet standpoint? I click here, and it shows me that nothing really happens except the growth of the property in the first 10 years. Then in year 11, you start to get the rent paid, and you pay the rent for those years, etc. Now, the client says, you know, this is if I do the house myself. What if I give half and my spouse gives half? So here, as I said, we scroll down to 50%. We can only give half. We take a 15% discount. And now the discounted value, $1,275,000. So the amount of the gift is significantly less. The second spouse does the same thing, but the second spouse is 65 and will also live to 88. So we're going to use a longer term for this spouse, go with the 13-year term, and very small gift, $466,000. And then we can run the numbers on Cupert 2. This is not yet exporting to a spreadsheet, but it will. Now, a married couple can do 3 Cuperts. They can each have a primary home they share, and then they can each have a separate vacation home. So I can do Cupert number 3 and just put in the information on Cupert number 3. Now, very soon, this will be exportable to a spreadsheet. There was also, here's something really neat. And by the way, I want to thank David Archer, my son-in-law, for doing the initial work on this, which became a really valuable base. And now Kevin Gray, who's been working on this day and night, mostly night, to make it how cool it is. These are some charts that Kevin just made up for the Cupert, showing you, first of all, the probability of survival based upon whatever age, and this is showing both of them. And then this shows you the property value over time, going up, up, up. And then this shows you the annual and total rent paid over time. This shows you the assets subject to estate tax if you die during the term, and what happens if you die after the term. And this I really like. This shows you the proportion of the tax you're paying here in orange versus the total tax you would pay if you had not done the Cupert. Now, this eventually will move when we move these figures. Aha, look at that. If I change the number of years, it shows me the risk is the higher I go in the number of years, the more savings there is. But of course, if you die, then you don't have the savings. But that is, I think, pretty darn neat. So let me see. Do I have a questions box, Josh, or can you help me find my questions?
Yes.
They seem to have disappeared. Sorry, everybody, I'm not all that tech friendly as I wish I was. There they are. Okay, here are some questions. Now, if this was French, it would be questions, but then I'd have to charge more for it because of the VAT. All right. So bring the questions over here. Try to expand them. Sorry, there they are. Okay, coming down. How much will this cost? The answer to that is more than you'll want to pay. Okay. Where will I be able to buy this? The answer is stay tuned. I'm not sure. Let me see if there were any questions. Okay, people have said, yes, I'd be interested in being a beta tester. Thank you very much. Let me see. Chewing up data hopefully will be allowed credit. Also will not download the handout. So we'll get when you email off CPA Academy. Okay, I apologize if you weren't able to get the handout from our system. We'll be sending you the handout and also a email where you can click to receive a copy of the entire video. If you have any questions, please just let me know. The email address is agassman@gassmanpa.com. Thank you very much for your patience with this presentation. We accidentally hit the start button before we were ready to start, and now I'll hit the goodbye button. Goodbye, and thank you for watching this mediocre presentation. You're terrible, you know that? Yeah, I know. Okay, bye.